A record $1.9 trillion was poured into ETFs last year. And in 2023, assets in these passive vehicles actually overtook that of active mutual funds. So if you want to invest into a global ETF, you have a few different options. And in this video, we're going to cover two of the most popular options from Vanguard and Invesco. I'll look to highlight some of the subtle differences that you may not be aware of to help you decide which might be the best suited to you. Both of these ETFs look to track the performance of the FTSE All-World Index. This is a global index that currently contains 4,243 companies. Of all the ETFs, a global ETF is going to be the most diversified. It's also going to be the most passive and hands-off because you're not having to choose a particular sector or region that you think might outperform. So the first thing we'll look at is simply the age of these funds. So the Vanguard fund was launched in July 2019 and the Invesco fund was launched in June 2023. This shouldn't be a deciding factor of which one you're going to invest into. I just wanted to highlight that because the Invesco one is so much newer, there is going to be less data compared to the Vanguard fund. And this does go some way to explain the difference in the size of these funds. So just looking at the accumulation version of each of these funds, in the Vanguard fund, there's around $14.3 billion, where in the Invesco fund, there's around $859 million. So as you can see, the Vanguard fund is way bigger than the Invesco fund. Now, some of that is going to be down to simply just being around for longer. It's had more time for investors to put money into it, and they've built up that trust. Some of that difference in size also goes somewhat to explain why there's also a different amount of assets held in each ETF. Now, both of these ETFs follow what we call a sampling approach, which means in order to track the index, they're not going to fully replicate it. Because there's so many companies in the index, over 4,000 companies, it wouldn't make financial sense to cover all of those companies. It would just be way too expensive for that ETF to do so. So what they look to do to make this more efficient is to implement a sampling approach. This is where they're going to invest into a slightly smaller number of companies, and they look for things like correlations. So if you've got two companies that are fairly highly correlated, it makes sense that you only really need to invest into one of those to track the same performance. And they do this across the whole index, so they can reduce the number of companies that they're having to invest into while still getting a similar performance to the actual index. But between these two ETFs, there is actually quite a big difference between the number of companies that each of them invest into. The Vanguard ETF holds around 3,618 companies, whereas Invesco holds around 2,413 companies. So as you can see, there's quite a big difference, and it's somewhat explained by the size of these funds. So with this sampling approach, there is obviously a balance. Obviously, the more stocks that you can include, the smaller tracking error you're likely to get in terms of tracking the index. But it also potentially increases the cost of that ETF because you're investing into a wider range of stocks. I imagine as the Invesco fund grows in size, the number of stocks that it tracks will actually also grow as well, and it will become closer to what Vanguard holds. But this doesn't necessarily mean that the Invesco fund is too small to invest into. When you look at the performance for both the ETFs and compare that to the index, they're actually very, very close. We can only really look at the last year because the Invesco fund was only launched just under 2 years ago. But if we look over the last year, the Invesco fund has actually beaten the Vanguard fund. It's difficult to see where this is made up of, but my bet would be that because it's invested into a smaller number of companies, there's a potentially smaller number of the developing and smaller companies in the Invesco fund that are slightly more expensive to invest into, which means it might have a slightly bigger weight in some of the higher tech stocks. So think of your Magnificent Seven. And although they have corrected recently, over the last year, they have massively outperformed and they've been dragging the market. So that's potentially why it's got a slightly higher return. But as we just discussed, the Invesco fund could increase the number of companies and then that's going to smooth out that performance and actually make the differences a lot smaller. This difference in the number of companies also goes somewhat to explain why there's also a difference in the annual management charge. So for the Vanguard fund, it has an annual charge of 0.22%. Where the Invesco fund is 0.15%. Now, these charges are not a direct charge to you. You don't have to pay that separately. That comes off the fund. So when you look at any price data, any performance data, it's already had that fee taken from it. So regardless of that performance of the fund, whether it's even negative, that fund manager is still going to earn that fee from it because it's taken from the assets under management. And it's somewhat explained because of the difference in the number of companies. Because Vanguard is investing into a wider range of companies, not only more companies, but potentially some smaller regions, some smaller companies and sectors that could potentially be more expensive. And that's why it's got a slightly higher management charge. And also, of course, it could just simply because it's been around longer. It feels like it can charge slightly more because it's built up that reputation, it's got the trust, and because it's one of the biggest ETF providers. There is another charge also that is not always that obvious, and that's the spread. So that's the difference between the buy price and the sell price. So if you were to buy and sell that asset within the same second, that's essentially the price you're going to pay. Now, these spreads will slightly change throughout the day, depending on the supply and demand, and simply just the time of the day. The Vanguard fund would generally have a lower spread than the Invesco fund. It's difficult to give you a specific amount because obviously it does change. But at the time of recording, the Vanguard fund is actually showing a spread of 0.04%, and the Invesco fund is actually showing a spread of 0.24%. I do have to say though, that is one of the largest differences I've seen, especially in the last few weeks. So it's not always going to be that big. But say you were to invest at this specific time, even though the Invesco fund has a lower annual management charge, because you're paying a slightly higher amount in terms of the spread, it would actually be more expensive to invest into the Invesco fund right now than it would be the Vanguard fund. Like I say, that's not always going to be the case, but it's just something to be aware of. So as you can see, it's very close between the two ETFs. And ultimately, I think it just comes down to which is going to be available on your platform. For me personally, I use the Vanguard fund via Invest Engine, but that's simply just because it's older and I've done it for a number of years, and you tend to just stick with what you know. I do expect the Invesco fund to continue to grow in size because of that slightly smaller annual management charge, and that spread will come down. That spread is only slightly higher because there's potentially less liquidity in the fund. By having a smaller fund size, there's potentially slightly lower liquidity, which means that's why there's more of a spread. But that will come down, and if that can be a deciding factor between investors, then the Invesco fund will likely grow quicker than the Vanguard fund. There are also other ETFs out there, so let me know in the comments if there's other ones that you use and if there's any others that you want me to run through. Check out my preferred investing platforms in the description below. Thanks for watching, guys. Hope you found that useful, and I will catch you in the next one.